Shares of ARM Holdings on pressure this morning. Take a look. The company reported perhaps weaker than expected guidance for the current quarter. It wasn't the earnings themselves, down 6.5%. Joining us now, Rene Haas. He's, of course, the company's CEO. Always happy to have you, Rene. And thank you for being here this morning. I guess the question I'm getting, certainly from those who own your stock, and I think many others as well, is what the impact of tariffs will be. I know it's very much uncertain at this point, to use a well-used word. But, you know, your CFO tried to at least give some semblance in terms of guidance, but then you did pull guidance for the full year. So give us that picture if you can.
Yeah, good morning, David, and thanks for having me. Yeah, we just came off the end of our fiscal year. So it was a record year for us, $4 billion in revenue. First time we ever hit that mark. We had also our first $1 billion quarter, and there was records both on the royalty side and the licensing side. On the go forward, we're looking at very strong royalty growth in the first quarter, 25 to 30%, which is up from about 17 to 18% of a year ago. So royalties look great. Our licensing business, as you know, is lumpy from quarter to quarter. So we were cautious in terms of deals that could fall in this quarter or the next quarter, and that was where we were regarding the guidance. You know, on the forward tariffs, what I would say is as following. We are now increasingly a royalty-based business, which means our partners are the folks who ship chips. And as they're now not giving a lot of guidance going forward, it's just a little bit fuzzy for us in terms of the end of the year. We're pretty confident about what we can see, obviously, in the last quarter and this quarter. But 2-3 quarters out, we're really following the guidance of what we see from our semiconductor partners.
You know, I wonder on that note, obviously, in the last 24 hours, even less, we've gotten the word that the diffusion rule, which was much criticized by many members of the semiconductor industry, may be going away and replaced with something else. Is that good news?
I don't know what the something else is. So, you know, we're in this world now where these announcements come out and you're trying to decipher what they are, literally from a week to week, day to day. So I think it's probably a little early to tell on what that is until we actually see it.
Well, you know, speaking of not knowing exactly what's coming in terms of the next few, I mean, overall demand, do you believe, is unabated at this point, despite what may be the impact, let's call it, over the next year of tariffs?
Yeah, you know, increasingly our business is being driven by AI and AI workloads. As you know, ARM is the compute platform that drives just about everything in your digital life. 70% of the world's population uses ARM, whether it's earbuds, mobile phones, PCs, automobiles, and the data center. Increasingly, all of those devices are now running some level of AI workload, whether it's training or inference. Obviously, the data center is where the huge growth is, but AI is going to run everywhere. So with that, we are seeing pretty strong macro demand for our technology because what's driving that demand is the need for compute. Running these AI algorithms needs more and more compute. And what we're not seeing is any back off of demand for more compute. In fact, we're seeing an acceleration in that. So in the long term, we're pretty optimistic. And if you look at, you know, David, where AI is, it's still super early in terms of seeing how large enterprises, for example, can use it. An anecdote that I had heard was, I think it was from my friend Alex Wang at Scale AI, is that ChatGPT used a petabyte of data to create the model. JP Morgan has 150 petabytes of data in their enterprise alone. So when you think about the enterprises using data sets for AI, it's early days.
You know, I'm thinking back to the even earlier days, Rene, where we were talking about whether or not AI spend was crowding out other types of tech spend. Do you think that sort of scenario is either accelerated or eased off?
I think they're all munched together, Carl, because if you think about the mobile phone industry, right, AI spend is a component of what goes into a mobile phone. A mobile phone will need more compute. It's going to need better battery. It's going to need more memory. Those are all good things, obviously, for ARM. But at the same time, that also drives overall demand for better products. So I think AI is sort of an umbrella for a technology that finds its way into really every single device that we're going to use. So I think it's a catalyst for strong demand broadly.
You know, we obviously speak about AI with you. You talk about it on the conference call and as well with your investors frequently. But at this point, doesn't it still represent a relatively small percentage of your overall revenue in terms of what you can say is derived specifically, let's say, from AI applications in the data center or in other places?
Yeah, so if you think about our revenue in the last quarter, roughly $600 million royalty, roughly $600 million licensing. I would say most of that licensing demand is AI, because what we're seeing is an uptick in demand for more and more compute. Licensing for us is the canary in the coal mine, if you will. It's a proxy for R&D. It's for people who invest in new chips and new products and new development. That's all AI. So we're seeing a very strong tailwind there. Royalties are trailing edge, so they're largely a function of products that were designed years ago, and we're taking a royalty from that. We're seeing an acceleration there too, though, David, because version 9 is a more heavy compute technology, and that's been accelerating in terms of overall usage.